Good morning all and welcome to Key Points Tax Matters VAT rate increase special. I'd like to extend a very warm welcome this morning to our clients, contacts, friends of practice and some of our competitors who have taken the opportunity to join us this morning. You're all most welcome and looking forward to talking to you about this seismic change that's happening in the Bahrain VAT landscape. Now, we've got a lot to go through this morning. We've extended our usual tax matters timeline from 45 minutes to 1 hour this morning because we expect there will be a lot of questions and indeed there is a lot of ground to cover. So this morning, what we're going to run you through is what's happened so far. We'll talk about some of the impacts that businesses could face ahead of a change in the rate of VAT. We'll talk about things like transitional rules. How do we deal with supplies of goods and services made around the change in rate, and some of the rules that we could see that may be similar to what we might have seen before in Saudi Arabia, which was the first of the GCC member states to raise its rate of VAT. And then we'll talk about some sector-specific issues that may arise for financial services, real estate, retail, because as everyone on this call will know, the rate increase or VAT itself affects different sectors differently, and a rate increase will do the same. You'll remember that from implementation. So I'm George Campbell. I'm the head of tax at Keypoint, covering the GCC region. I'm joined by Tariq Haq, who is the senior manager in our VAT practice. He's an ex-tax inspector from the UK, so he can give a fairly unique, as far as the region is concerned, fairly unique view on tax authority approach. We'll bring Tariq in later in the presentation to talk about some of the things that he's seen from a tax authority perspective in the region around rate changes and what businesses might expect in Bahrain. Also joined by Abdul Rahman Buchiri. He is a manager in our VAT practice, and amongst his specialisms is financial services, the impact of partial exemption on businesses, and so when we talk about some of the sticking costs that businesses may see increase with the rate of the increase in the rate of VAT, Abdul Rahman will give us his learned view. So moving on to what's happened, obviously this has gathered pace quickly. It was to a certain degree unexpected and expected. There are certain economic reasons why raising the VAT rate is a good idea at this point, but it has come around rather quickly. And so really we have done our best to react as quick as we can to this, because having seen businesses through rate increases in Saudi Arabia, I personally have seen 2 rate changes in the UK, a drop to 50%, an increase to 20%, and then obviously the Saudi Arabian experience. We know that reaction times here are key, and there are many things that businesses will need to do before the proposed change from the start of next year. Now, at the moment, it's a Council of Ministers approval that then must go through Parliament and Shura Council before it becomes effective. However, what the Council of Ministers has approved is an increase in the rate of VAT from 5 to 10% from the 1st of January 2022. Now, that means it's not at the moment anticipated to affect any other supplies. So things currently subject to exemptions such as property rental, certain financial services will not change, nor will the zero ratings for example, exported service or any of the basic food items and oil and gas products that we see in Bahrain. Those will not be affected by the change. What this has, the effect of this change will be that anything that is currently chargeable at 5% will become chargeable to 10% VAT from the 1st of January 2022, and that means certain things for businesses, both acting as supplier and customer, buying from other businesses, and then for us as individual consumers in the Bahraini in Bahrain. Now, we do benefit from a number of exemptions and reliefs, exemptions, zero ratings, things that mean that VAT is not chargeable to us at the end of a chain of supply. So your standard basket of goods and services that you buy that make up your monthly expenditure will continue to benefit from the same reliefs and concessions that they currently do now. However, on things on your taxable expenditure, on the things that you buy which are subject to positive rate VAT, those will become more expensive. Caveat by saying, as long as suppliers will increase prices or can increase prices to pass on that additional VAT, and we'll come on to some pricing considerations later in the presentation. One good thing that we have seen, and that will be good news to Bahraini citizens, is that whilst VAT is chargeable on certain utilities, those utilities, or the VAT on those utilities, will continue to be borne by the Bahraini state on their behalf. So costs and price shouldn't increase for those individuals. So one of the questions that I get asked, and one of the things that we see quite frequently, and I've seen this, like I say, twice in the UK, once in Saudi Arabia, it's just a flick of a switch, isn't it? It's just a case of changing from 5% to 10%, charging a bit more, paying a bit more to the government, paying a bit more to suppliers, recovering it, it'll be fine, won't it? Yes and no. It would be disingenuous of me to tell you that this is the most complex thing in the world, but it would equally be irresponsible of me to tell you that there weren't some serious considerations here that you need to review and interrogate before well in advance of the 1st of January 2022. So in principle, yes, we have a simple change. 5% or positive rate, taxable goods and services at 5% become chargeable to 10%. But having just been through a change in the VAT rate last year in Saudi Arabia, we can, in very good conscience, tell you that it's not going to be as easy as it may seem on face. So there's a few things we're lucky. We have effectively second mover advantage here with the change in Bahrain rate coming after the Saudi Arabian VAT increase. There are certain things that we can learn. Now, I'm sure that one of the questions that will be on many minds at the moment is, how do I continue to benefit from 5% VAT? Will I be able to continue to benefit from it after the 1st of January 2022? Can I accelerate some purchases? We will expect there will be rules to combat any kind of artificial benefit that may be derived from shifting supplies around, let's call it the date change, the 1st of January 2022. So you have your normal time of supply rules which trigger tax points on the issue of an invoice, on the payment for goods or services, or the delivery of the goods or services themselves. But there will be rules where, if, for example, businesses try to prepay for things that are delivered after the date of change, then there will be mechanisms in place that mean that that effectively apply an additional tax charge in order to mean that you can't take advantage of the previous rate artificially. So we will have special transitional rules which will be aimed to, they're effectively anti-avoidance measures to combat any artificial benefit derived from accelerating supplies. And those will generally be around where you make a payment up front, or a supplier issues an invoice to try and artificially trigger a tax point. So what will happen is that, or what we expect to happen, and particularly if we look at the Saudi example, is that the transition rules will look at when the supply is actually made, so when the goods or services are actually delivered. So in certain circumstances, we will expect people to try and benefit from 5% by receiving or making prepayments, issuing or receiving invoices to trigger tax points under the normal rules. But we expect transitional rules to say, if you do that and the supplies are delivered after from 1st of January 2022, they will be subject to 10% VAT. So government's very used to anti-avoidance measures of this sort. When a rate changes, there are global principles and precedent to deal with this sort of issue. And then there will be complexity. And again, we saw this in Saudi Arabia with long-term kind of continuous supplies. We expect there will be rules that mean that those supplies, if they straddle the date of the change, will need to be apportioned between the 5% rate and the 10% rate. That could mean additional invoicing. You will see, if you're a supplier supplying these types of services, you may see pressure from your customers to say, well, I want you to invoice everything that you do for me up to the end of the end of this calendar year at 5%, and then you can apply 10% thereafter. I caveat again by saying, as long as contractual arrangements allow for that to be the case. So moving on, another question that, and I suspect this will be the most technically challenging, certainly again from what I've seen in other jurisdictions. Will there be grandfathering? Will there be the ability to continue to apply the 5% rate of VAT after the rate of change in certain circumstances? Now, businesses are quite used to this term, certainly in the region of this term of grandfathering. The allowance of the previous VAT regime or no VAT around the date of implementation being applied after the VAT change or VAT becomes effective. And again, this was something that we saw in Saudi Arabia. We did also see it on the implementation of VAT, where certain contractual arrangements could benefit from continuing to be free of VAT for a set period of time. Now, looking at the Saudi example, the Gazette, as it was before it became ZATCA, allowed businesses to continue to charge the previous rate of VAT in very specific circumstances relating to certain invoices that were raised or contracts that were agreed before the announcement date, before taxpayers could legitimately expect that the rate of VAT would change. That date was the 11th of May 2020 in Saudi Arabia. So that became the reference date by which Saudi Arabia applied its concessions. And what it said was, if you issue an invoice for a supply before the 11th of May 2020, e.g. 10th of May and backwards, but the supply is delivered after the 1st of July, you can still apply 5% VAT to that supply, provided that the supply is delivered before the 30th of June 2021. With respect to contracts, this was slightly different. And the date of 11th of May 2020 was still relevant, but the contract rule was only applicable where supplies were made to certain customers. So the transitional rule on contracts said that where a contract is agreed before the 11th of May 2020 with a customer who can recover all of the VAT or a government body, 5% VAT can continue to apply to the supplies made under the contract until expiry of that contract, renewal of the contract, or indeed any amendment as Gazette applied, or the 30th of June 2021. Now, one of the questions that I was asked was, and frequently, some people on the call or the webinar will remember this, can my purchase order constitute a contract? Now, in our discussions with the authorities and discussions with taxpayers, it became apparent that that was permissible. So a PO, as long as it's signed, it identifies the relevant parties, the supplies, the consideration, can constitute a contract for VAT purposes. and therefore allow the transitional measure to apply, whereby 5% VAT could continue to apply with backstop of the 30th of June 2021. Now, a lot of suppliers and the customers spent a lot of time looking at contracts, invoices to work out whether eligibility was there. We had customers put a lot of pressure on their suppliers to continue to apply 5% VAT. And suppliers in a very difficult position where, sometimes there was no black or white, yes or no answer, but indeed shades of grey and therefore risk as to whether they could apply 5% VAT. Where neither of these reliefs was applicable, only supplies delivered before the 1st of July 2020 in Saudi Arabia, that was the effective date of the rate change, could be subject to 5% VAT. And you had those anti-avoidance measures whereby, even if an invoice had been issued before 1st of July, even if a payment had been made or received before that date, if the supply was delivered thereafter and no relief applied, then 10% VAT would apply. And again, like I say, we expect to see something very similar in Bahrain when it announces, well, first of all, when it confirms that the rate will increase and when it announces its transitional rules. As I mentioned, for continuous supply straddling the rate change, there was an issue of apportionment. And again, we saw a lot of businesses who said that that's just too risky for me. I'm just going to apply 15%. Now, rightly or wrongly, they took what they considered to be a prudent stance, and I'll come on to whether that was a good idea in a minute. But it did again cause a bit of friction with customers who were on the receiving end of that 50% VAT rate, 15% VAT charge, particularly if they weren't able to recover the VAT that was chargeable, and it was going to impact their bottom line. So, in summary, just to summarize, I guess, the last few slides of what I've said, we're expecting this rate change to take place from the announcement, the 1st of January 2022. It will apply to standard rated supplies, and there will be a lot of complexity around the date of rate change. There will be questions over which rate applies, whether concessions apply, and there will be a lot of discussion between you and your suppliers, you and your customers, about whether VAT can be charged to them, whether reliefs apply, particularly if VAT is going to impact the bottom line of those businesses. So, in the context of Bahrain, we've talked a lot about Saudi Arabia. Let's talk about what we're going to expect here in Bahrain, because that's what's most important. Now, when we talked about transitional rules, what became clear was that it was the announcement date of the change in rate that was very important. Effectively, when could taxpayers have a reasonable expectation that the rate would change? In Saudi, that was very clear. The announcement and the matter effectively coming into force was very clear. It was from the 11th of May 2020, and therefore that kind of became the cutoff date for the application of transitional rules, or the date by which invoices issued or contracts signed would be judged. Now, at the moment, we've got no official confirmation that Bahrain will absolutely 100% change the rate of VAT from the start of next year. We fully expect it. It's been approved by the Council of Ministers, but it still needs to be approved by the Parliament and the Shura Council. However, when we look at the date with respect to where transitional rules will apply, I would fully expect that cutoff point to be the 27th of September 2021, when the measure was passed by the Council of Ministers, because certainly our view as a practice is that any deviation from this date gives an opportunity, at least in principle, for businesses or bodies to manipulate the VAT system, to accelerate supplies, to quickly sign contracts, which could be dangerous either way, I guess. Either you fall foul of transitional provisions, or you jump into something which has not been fully considered because there's a VAT pressure. And something that I always say is not to let VAT dictate the way that you do business. I expect the 27th of September 2021 cutoff on transition rules. I may be wrong, but weighing this up from a reasoning perspective, that would make sense, because it really at that point became apparent to Bahrain's business that this was a legitimate, let's call it, threat of raising the rate of VAT. So that's what I would expect. Now, I did mention that that's going to precipitate a lot of discussion between US suppliers or US customers with your customers and suppliers respectively. Now, I think there's as with any significant change, especially where there's uncertainty, that there may be some difficulty for suppliers and customers in, for example, applying transitional rules. And again, in Saudi Arabia, we saw quite a lot of friction between suppliers and their customers, and customers and their suppliers, about the application of transitional rules, with customers saying, we are absolutely eligible for this, you should apply it, and suppliers saying, no, we don't want to. And one of the key factors of the VAT rate change in Saudi Arabia, particularly with respect to transitional rules, was that those application of those rules was, or the transitional relief was optional. So it said taxpayers may charge 5% VAT in these certain circumstances, rather than taxpayers shall or must. And that's a big issue. Now, it makes sense from a VAT risk point of view, because particularly where you may rely on, for example, in the context of the contract rules, rely on the confirmation of the status of your customer. Are they fully taxable? Can they recover all of the VAT of the supply, or are they a government body? Sometimes those questions aren't easily answerable, and suppliers particularly need a kind of backstop to fall on to say, well, look, I'm not comfortable that this is, I meet all of the conditions here. ZACA or the NBR could come and assess me if I get this wrong. So my relief needs to be optional. And like I say, indeed, some suppliers said, no, we are going to apply 15% VAT from the 1st of July in Saudi, and we may 2020, and we're likely to see that again from the 1st of January 2022 in Bahrain. Now, I would say with I've worked extensively in Saudi Arabia and on ZACA matters. I can say in good conscience that the business's reluctance to apply the transitional rules and measures was not misplaced, and indeed what we have seen come to pass. And I'll maybe bring Tariq in a second. What we've seen come to pass is quite an aggressive ZACA with respect to application of the transition rules. Now, Tariq, from your perspective as a former tax inspector, you've come from the UK and you've seen how ZACA has approached this. What is your view, and what are some of the issues that you've seen where businesses did or did not apply the transitional rules?
Thanks, George. So it's interesting. I mean, ZACA's approach, just very generally, most taxpayers who operate in Saudi will know that they're aggressive just by nature as compared to other tax authorities. What I've seen over the last few months is where clients are reporting supplies which they consider still subject to the transitional provisions in their current VAT returns. I've seen ZACA sort of go ahead and assess them without really sort of digging in further to check whether they have the relevant documentation, whether the supplies were in fact completed before the 30th of June 2021. I've seen them approach where the customer, the customer status in Saudi, the way they work is you can assume the customer can recover in full unless you know they can't for some reason. or if they are involved in certain industries, for example, like financial services, etc. But I've seen the Zatka just go ahead and sort of be happy to issue an assessment and sort of, here's your assessment and we'll think about it later, so you can go down the appeal process, which has created complications. And I think what clients could have done probably better is to make sure the invoicing was done in good time. For example, if we're in September and you're issuing invoices for, say, June or May earlier this year, then by default you're late because you've not issued by the 15th of the following month. I've seen that sort of across all the sectors. And the thing is, obviously with Saudi, they have automatic application of penalties, which has resulted in some really poor outcomes for clients. And I've had a case, George, where the client has, accepted, okay, we may have got the application wrong. Can you please give us a list of customers that you're referring to? But the Zakat has not come back and given any list. So they're appealing without really knowing exactly what the penalty and the assessment relates to in terms of transaction type or the transactional data itself. And I've seen, and as you touched upon earlier, I've seen invoicing being done early as well. Zakat has not picked this up just yet, I don't think, but a lot of, I feel taxpayers, not all, I wouldn't say a lot of, but a considerable amount of taxpayers still think that if you invoice in time, then, it's fine, but actually it's not, because the goods and services, the performance of services and the delivery of goods in most circumstances takes precedent, and the other tax points sort of are disregarded for the application of the transitional provisions. So that's the sort of a flavor of the things I've touched upon over the last sort of 3-4 months.
Thanks, Tariq. Those are some great points. It's been really difficult for businesses in Saudi Arabia. I just feel that the transitional measures are always complex. They're always complex legal provisions, and they take time to distill and really get to the bottom of where, in what circumstances relief can apply. And of course, if you're a supplier and you are you're making a decision as to whether to apply 5% VAT, or indeed, I'll come on to, can you charge 15% VAT? But if you've got a choice between the two and legally you're allowed to increase your price to your customer, in Saudi Arabia, it makes sense for businesses to take a very prudent approach. But as you touched upon, and as I mentioned, there are commercial pressures there that sometimes can override the appetite not to take risks. So, in Bahrain, slightly different, because we have a tax authority that seems to have given businesses time to get used to the huge change that is the introduction of VAT, and so maybe we'll obviously have to see the transitional rules, but maybe we have more of an opportunity for suppliers to apply the reliefs, because they're not so terrified that they're going to be hit with enormous assessments and automatic penalties. A lot of things we just have to wait and see. It's early days, but we're in a more fortunate position in Bahrain with respect to time to get ready, because there was more than 3 months from this announcement date of the 27th of September until the proposed rate increase date. So that's kind of good news, but we really need to, businesses ourselves as suppliers need to move now to make sure that we can adapt to this. Just moving on to the next piece. There are some general impacts that I guess some or all businesses must consider, because a VAT rate increase does also mean certain things for pricing, competitiveness, cost, working capital, relationships between suppliers and customers, whether that be business relationship or legal contractual. There are there are a number of obstacles that must be navigated. So if we just maybe run through these very quickly, because we do want to allow say 15-20 minutes for questions. Pricing can be a challenge. Businesses, again, maybe who've not been through this will turn around and say, well, I just increased my price, don't I? I just add 10% VAT. Well, that's fine if maybe you're in retail, you can change your list prices, your shelf prices. The market will take a 5% increase in the cost of your goods or indeed service. But many businesses will be in the situation where they have agreed maybe fixed pricing with their customers under contract, and they won't be able to increase their price. Now, if you've got wording in there that says we will charge VAT at the prevailing rate, then of course you can adjust to charge 10% VAT. But then your customer may come back to you and say, well, there are transitional provisions that I want you to use. And then you're stuck looking through the legislation, working out if this can be, if 5% VAT can continue to be applied. So there are, legal, there are business relationship issues, there are competitiveness of market issues on whether prices can be increased to reflect additional VAT. Now, on the cost side, we've talked about charging VAT to customers, where those customers are individuals. Obviously, that increases absolute cost, but it will also increase absolute cost for some business-to-business supplies. So we'll come on to how that will affect certain industries, but where you're paying more VAT, maybe waiting a bit longer to claim it back, there will be working capital issues. And on restricted VAT, under a 10% rate, absolutely you can expect an increase in total cost that will hit the bottom line. Now, we'll need to wait and see what transitional provisions there are and how they will soften that. We've talked about some of those, but we expect them to be available. We do expect them to be complex occasionally in their application. As with any VAT change amendment, there will be systems issues. What do you need to do to your system currently to make sure that it can apply 10% VAT successfully, 5% if you're using transitional rules? There are a number of considerations there. And then on the documentation that those systems produce, which of those will be affected? How do you update templates, data fields to make sure that the correct rate of VAT is applied? And again, this can be impacted by transitional measures where you may be running a number of rates or 2 rates of VAT for standard rated supplies for a period of time. And with that, what impact or what policies and procedures do you need to have in place to make sure that you correctly apply VAT, again, in the context of uncertainty on which rate should be applied? There need to be processes and procedures to make sure that any potential application of transitional provisions is carefully considered and then correctly applied on supplies that are made to customers. And then, related matter, contracts. How many, for example, as a business, how many long-term contracts do you have of significant value that could potentially be impacted by this? What's for you charging VAT? Will you be able to? Will you be legally allowed to? And if not, will it impact, how much is it going to impact your bottom line? Because correspondingly costs may increase. And then from a customer's perspective on long-term contracts, are your suppliers going to be charging you additional VAT? Are they entitled? And what does that mean for your overall cost profile? And related to cost, I did just touch on cash flow, but will cash flow be sufficient to cope with the additional VAT that will be charged, that you will have to pay and claim back from the tax authority if you are eligible? Now, that's a timing issue. You may need to look at your budget, whether it's appropriate, it gives you sufficient cash flow, or indeed look at your processes for example, VAT recovery and how quickly you're able to get that back so that it doesn't become a long-term working capital problem. Data integration, if you're dealing with 5% and 10% VAT at the same time because you're applying some transition reliefs and you're not in other circumstances, then you will need to have potentially 2 different data sets for your supply and your purchase profile. We'll come on to partly exempt businesses and how VAT is going to impact them, and I think Abdul Rahman will give us some insight there. But lastly, at the bottom of this list, customer communication. We've talked about some of the conflicts or frictions that may arise between parties and supply chains. Suppliers and customers need to talk to each other about this change, particularly where it's going to impact bottom lines, budgets, and where it relates to contracts between the two parties. So I mentioned that the businesses with exempt supplies are likely to suffer an additional irrecoverable VAT cost. I think with Abdul Rahman's expertise in this area, the amount of advice that and time he spent with financial institutions, I'd kind of like to pass it across to him here to just tell us about a bit more about what businesses, let's say, who can't recover all of their VAT and are partly exempt, will see with respect to additional VAT cost and irrecoverable VAT. Abdul Rahman, over to you.
Thanks, George. I'll just talk a little bit about the increase in irrecoverable VAT costs that partially exempt businesses will face as a result of the expected increase in the VAT rate. So actually, we've already had some of our financial services clients request our help with estimating the additional hit to their bottom line from the increase in irrecoverable VAT expenses. But what we haven't seen so far, and I expect this to change very soon for reasons that are clear, is the beginning of a conversation by these impacted partially exempt taxpayers on any concrete actions or steps to be taken by them to reduce or at least to pass on some of these additional recoverable VAT expenses. So from our experience, the typical retail bank in Bahrain has a recovery ratio of anywhere from 10 to 30% approximately. So in the absence of any mitigating measures, the doubling of the VAT rate will, it will undoubtedly hurt the profit margins of these banks and of any partially exempt business with a, similarly low recovery ratio. This, in our view, this is an indirect but a very real cost of engaging in exempt business activity and of making exempt supplies. And in our view, the VAT rate hike will force this issue to the surface. So in terms of potential mitigating measures that impacted firms can take, the first and most obvious is price increases, trying to pass along the costs, the additional costs instead of absorbing them. So for banks, they may want to consider things like increasing their interest rates on loans and things like that. Of course, with price increases, you have, additional things to consider, such as competitive pressures, especially in case other competitors do not also increase their prices in response to the same issue. Apart from that, there are several purely VAT-related measures that impacted firms can take to reduce the impact of the increase in irrecoverable VAT costs. And one of them is reviewing the firm's current direct attribution of expenses. We believe that especially for the larger and more complex banks and firms, this increased complexity has probably resulted in some untapped potential in terms of increasing the number and value of expenses, which, upon a an additional detailed review may be considered as directly linked to taxable supplies and therefore fully recoverable. Besides that, I think that partially exempt businesses should also explore whether applying any partial exemption special methods would provide them with a material increase in their recovery ratio, thereby offsetting part of, or possibly even all of the additional recoverable VAT costs that they would be facing otherwise. So in Bahrain, the MBR has yet to publish a partial exemption special method guide similar to the one issued by the FTA last year in the UAE. but the possibility of submitting an application for a partial exemption special method, it's included in the Bahrain VAT regulations, as almost everyone is aware. And so partially exempt businesses should really look to take advantage of this if doing so is found to be in their financial benefit. And of course, if they can demonstrate that the selected special method meets the standard test of being fair and reasonable. Back to you, George.
Thanks, Abdul Rahman. I think that was really good in terms of highlighting these significant pressures for partly exempt, financial institutions, even it affects the real estate sector. Similarly, but just with I guess Bahrain's footprint on from a financial services point of view, I think it's really important that we highlight these issues. And I'll come on to the fact that there are some mitigating measures that we can take, regardless of sector, to improve VAT cash flow or to optimize our position to make sure that 10% VAT hurts us as little as possible, because it is going to be difficult. And just moving on to kind of the second bullet there, businesses supplying continuous supplies, apportioning between new and old rates is going to be particularly complex. Again, Bahrain has quite a large insurance sector, and the insurance industry did suffer, I saw in Saudi Arabia, from the change in rate, and it was particularly around this issue: what rate of VAT applies? Is there apportionment? Do I owe that? And also on implementation, it was the same issue. So continuous supplies, expect that to be complex. Long-term contracts, almost partly linked, but in the context of the Saudi Arabian transitional rules, if we put that in a Bahraini context, will my long-term contracts with government or other taxable persons be subject to transitional relief if I agreed them before a certain date? And just at this point, I did have a look through some of the Q&A ahead of the end of the session. The Saudi Arabian transitional period lasted for 1 year, from the 1st of July 2020 to the 30th of June 2021. So it's actually ended not that long ago. Onto retail businesses, again, question: can I increase my price? Will the market take it? Will I be able to update list prices, sticker prices, shelf prices? How do I deal with rebates, discounts, vouchers that I've issued, because they may span the rate of change? I may have sold something in 2021, I give a discount or a rebate or a refund for it in 2022, or I sold a voucher in 2021, I'm redeeming it in 2022, there will be VAT impacts. On VAT cost, and I guess kind of related to the top bullet, but in a different context, if you're a non-registered business, maybe below the threshold, or you're only making exempt supplies, you will see an increase in your total VAT cost. And there may be things that you can do to combat that, but at the same time, there may not be, particularly if you're not locked into fixed price contracts with your suppliers. And then lastly, we do have the ability for non-resident businesses and bodies to make refund claims to the Bahraini government for VAT that they incur in country. We've not seen a huge appetite for that, because at 5% rate of VAT, there are some businesses that it's less cost effective to claim the VAT back than it is just to let it pay it and let it go. 10% VAT may change that, and businesses might see an incentive to make foreign refund claims because their cash flow is impacted. So just moving on, what should you be doing now? And I think we've covered most of this, but when I mentioned the 3 months that we do have, roughly 3 months between announcement and potential effective date, we've got a bit more time than Saudi Arabia had. They had about 7 weeks. We've got 3 months. So there is time to fully consider all of these things that we've covered so far. the most important thing, top of the list, plan and prepare. Start talking now with finance, legal. Start looking at your contractual position. Understand your market position. Can you or should you increase price? What will be the impact on cost? How will it hit the bottom line? How can it be cushioned? You know, we talk a lot about legacy arrangements, contracts with customers and suppliers, especially with those that are of high value, especially where they are potentially quite old. They really need to be reviewed carefully. And then once you've determined the correct application of the tax, updating your systems, your rates, tax codes. You may be running, as I said, 5% and 10% VAT for a period of time till the end of transition, and maybe a while thereafter. And documentation, templates, invoices, credit notes, debit notes, all of that will need to complement and match what you apply from a VAT liability and systems perspective. We've talked a lot about impact on cost. Look, most businesses' VAT recovery position will be impacted. That may be absolute, it may be cash flow, but it does warrant a careful look as I said, whether budgets are appropriate and whether there's anything that you can do to kind of optimize or streamline your VAT position or process so that you don't hurt so much from a 10% rate of VAT where it does apply. Now, coming on to some of the things that you can do very briefly before we jump into the Q&A, which I see a number of questions. From what can we do to help you as advisors? Now, I just mentioned that we've been through, well, I've been through 3 changes in the rate personally, and all of the other members of the team that you see here have been through the Saudi rate change very recently. We can help you to get it right, guide you on the complex matters, particularly around transition. And I think for me, that's the most important part because it's the part where there are or where there is most risk. But we can also advise you on your contractual positions. Should you accept an additional VAT charge or an increased price to reflect increased VAT, and indeed from a supplier perspective, can you charge it? But where VAT or increased VAT cost is just going to become a reality from our mature VAT jurisdiction experience, there's a lot of things that you can do to cushion the impact of this. Abdul Rahman talked about alternative and potentially more beneficial rates of VAT recovery for partly exempt businesses. An important point, and I did see this raised in the Q&A, 10% VAT will apply to all imports from the date of change. Now, if need be, there are measures within or provisions within the legislation that allow for deferral of import VAT to the VAT return. That could be very beneficial from a cash flow perspective. Otherwise, optimizing your AP process and making sure that you claim VAT at the earliest possible point could be a way to soften the blow of 10% VAT. If you have a lot of intra-group supplies, you suffer a VAT restriction or a cash flow issue, you may consider VAT grouping. We're working with a number of businesses on that at the moment under a 5% rate anyway. Similarly, and maybe related to AP process, you might look at where you under recover VAT. Are you maybe being overly prudent? Have you missed something? Have you missed an opportunity to recover tax? We can help you with that. I guess related to, again, optimization of process, time of supply management. Are you triggering tax points too early? Are you saying that you owe VAT too early to the tax authority? Could you look at your time of supply and be more efficient and pay VAT closer to the tax authority, closer to the point when you receive it from your customer? And then again, similar, on a similar vein, transaction planning. As tax advisors, VAT advisors, we see a lot of businesses undertaking transactions quickly and not fully planning for the impacts of VAT. So that brings to a close our presentation session. Now, there has been a lot and we have gone on for quite a period of time, but maybe I will go through some of the most interesting or maybe applicable questions that have been asked by our participants. Thank you very much for these. So let's look at the. We'll look at. I've got a question here. It says, "Our contract is with one government entity only. Do we need to consider anything from customer status point of view?" If we looked at the Saudi Arabian example, and again, we've only really got Saudi to go on as the most recent example, yes, you would need to consider the status of the customer now, where it's very clearly a government department, and say, for example, the transitional rules say that one area of relief is on supplies to government, then you will need to be, like I say, very sure on the status of that customer. And as we've seen in Saudi Arabia, which has published a lot of guidance on VAT, government departments or bodies can be seen very differently from, for example, subsidiaries that they own and control. So there may be differences in the application of transitional rules if it stipulates it must be to a government customer or fully taxable. There may be differences in the application of transitional rules between government bodies themselves and some of their subsidiaries and legal entities. And so I just wanted to take a while to scan down to this question, because I did see it earlier. And it's a really important one. It says, "Is it better we sign a new contract now as the current one is about to expire?" And my understanding would be that this is in relation to, how long can I apply 5% VAT? Should I sign one now and continue to benefit from being able to charge the 5% rate, or in the case of this question, receive the 5% VAT rate now? If 27 September is the cutoff date for application of the transitional rules, again, taking Saudi Arabia as an example, then it's not going to make a difference whether you sign your new contract now or you sign it at a later date, because I would expect that if your supplies are delivered or indeed received after 1st of January 2022, then 10% VAT is going to have to apply anyway. Now, we can't say that will absolutely be the case, but because Bahrain may deviate and introduce different transitional rules. But if, like I say, 27th of September 2021 is the relevant date for or watershed for application of transitional reliefs, then it may be too late. And I would say in all circumstances, if you're going to sign a new contract anywhere around the change in VAT, you should take some proper advice on it, particularly if it's of high value. The next question that was of interest to me, it said, if the VAT rate increases to 10%, management wants to apply 10% to everything to make it easier. Is there any issue with this approach? Now, let's talk about transition. If the application of transitional reliefs is optional, then, and your supply was delivered after the 1st of January 2022, then you, under normal VAT principles, would be entitled just to apply 10% VAT. That's if you have an optional relief. If it's mandatory, which I wouldn't expect, then it's a different matter. But you will need to be careful, because again, if the transitional rules are the same as what we saw in the implementation of VAT on the change of the rate in Saudi Arabia, if you deliver a supply before, or make a supply before by the end of 31 December 2021, before the rate changes, that supply should be subject to 5% VAT, even if you invoice or receive payment afterwards. Now, the problem with taking a prudent or overly prudent stance, applying 10% VAT to those types of supply, is that you will technically apply the wrong rate. That the correct application of VAT is not an option. That means certain things for you. You'll have overcharged VAT, so you're probably unlikely to get a penalty. Although it's not out with the realms of possibility, but it may cause an issue for your customer, because if you've charged the wrong rate of VAT and they recover it, then they will have over recovered VAT from a VAT technical perspective, which then leaves them open to potential penalties and a very awkward conversation with you as supplier. Abdul Rahman, I think one for you, and obviously the special method is starting to pique the interest of people. How can we apply for the partial exemption special method?
So George, in the absence of a sort of formal application form by the MBR, since it has yet to release that, I think that taxpayers are left to sort of draft an application and either submit it to their relationship manager if they have one. If not, they should just submit it to the MBR contact center, the general contact center, and take it from there. Now, of course, with regards to any partial exemption special method, it's not enough to simply say, what, this particular method provides me with VAT savings, so I'm going to apply for it. That's definitely not how it works, because the taxpayer, as I mentioned earlier, he must also be able to prove that it results in that the method is fair and reasonable, as in it accurately reflects how costs are used in the business, and it is not sort of overly complex and burdensome for the taxpayer to operate, as well as for the MBR, for the tax authority, to audit and review, upon any VAT audit or inspection.
Perfect. Thanks, Abdul Rahman. I think the market is really waking up to this opportunity now, certainly from our perspective, and this is going to become a bigger issue. How do I go about agreeing this with the tax authority? Because 10% VAT is going to be very worthwhile for certain businesses. I have another question. When importing bulk consumer goods, will customs charge me 10% of the total value of the invoice? So I think we may have covered this slightly, but it's maybe a planning point. Whereas there are transitional rules for the kind of local supplies, B2B, on matters relating to, for example, import of goods, it is a bit more black and white. Customs will apply 10% VAT on the landed costs, so the cost, cost, insurance, freight, duties at the point of import. So VAT will be charged by reference to when goods are cleared into Bahrain. What is the time of importation? If that is before, so up to the 31st of December 2021, 5% VAT should apply. If there's any delay and it ends up happening on the 1st of January 2022 or thereafter, 10%, the 10% rate of VAT will apply. I think we've got time for one last question, and it's quite it's a reasonably big one, and it's a very good one. Considering the VAT rate change takes place from 1 Jan 2022, if we receive an advance payment from the customer now in October 2021 for the delivery of goods in January 2022, shall we charge 10% VAT to the customer when issuing the invoice for advance payment? So at the moment, you cannot, and this is very important right now, and until the rate actually changes, you're not permitted to charge 10% VAT. Now, this question has all sorts of different angles to it, because there are potential applications of transitional rules, etc., etc. But if you've received an advance payment now, you need to look at, and you're going to make this apply thereafter, you will need to look at the transitional rules. Are there any reliefs on invoicing, which if it took place after the 27th of September, probably not, or did I agree a contract for this before the announcement day, and can my customer recover all of the VAT, or is it a government body? Again, I caveat by saying that's the Saudi example, but you'll need to look at the status of your customer in the context of the Bahrain transitional rules. But it may be the case that you also need to apply an additional VAT charge at the time those goods are delivered. At the moment, you have to charge 5% VAT. You'll need to look as to and review as to whether there's any relief that can be applied. If not, an additional invoice will need to be raised for the additional VAT in 2022, and that tax paid over to the NBR. Again, expecting the same kind of transitional rules on or anti-forestalling measures for advance payments and invoicing. I've gone slightly over. It's now 11:01. We do have some open questions, and we will answer those and issue those answers to the participants this morning. But that brings to a close our tax matters special. I think maybe Tariq, if you just want to click back to the previous page with the team members, feel free to contact any of us, and we will distribute this presentation to the participants as well. But feel free to contact any of us if you have any burning questions on this rate increase, because it is a complex one. We have run over time. There's a very good reason for that. There are a lot of questions and there's a lot of ground to be covered. It will be the same over the course of the next 3 months. So if you do need any support, any guidance, we are more than happy to help. So please feel free to get in touch. Thank you very much.